Hi! So in the last video, we spoke about how mutual funds work, what are the different kinds of mutual funds, and what are the advantages and disadvantages of mutual funds. So in this video, we can maybe take a look at how are the returns calculated, what are the tax implications, and what are the most common mistakes that are made while investing in mutual funds. So let's get started. There are two ways to invest. One is lump sum. That means that we have a lot of money and we're putting all the money directly into the mutual fund. Second one is something called SIP, which is the systematic investment plan, which means that at a regular interval, say monthly or once in 2 months, we put in a little bit of money in it, and if we want, we can keep increasing it by like 10%, 15% or whatever as per our convenience. But what happens in this case is that even though we are starting off small, with consistent putting in of money, eventually the mutual fund will grow. Now let's just take a look at the many terms that are used when someone is talking about the performance of mutual funds. So the first one is the net asset value. So the mutual fund is considered the total asset and the value of the mutual fund is taken into consideration. Now, any increase in the value of the mutual fund, which is the net asset value, is considered the return for the investor. So, for example, if an investor buys a mutual fund at 100 rupees and then it increases to 110 rupees, the return will be 10%. The second one is absolute returns, calculated on absolute value of the investment over a period of time. So, for example, if I invest 1 lakh rupees in the mutual fund and it increases to 1,20,000 rupees over 2 years, then the return is 20%. Third one is the annualized returns. This is basically the average yearly returns. So, for example, if your mutual fund has 20% return over a period of 2 years, that means the annualized return could be around 9.6% per year. The fourth one is the SIP returns. In case we're investing in form of SIP into the mutual fund, then there's a separate extended internal rate of return calculated, which uses the method of multiple cash flows over a period of time. The taxation of mutual funds mainly fall into 3 categories. One is equity, one is debt, and the other one is dividend. So for equity, if the units are held for less than 1 year, they're considered short term. If they're held for more than 1 year, they're considered long term. In case of debt, if the units are held less than 36 months, which is 3 years, it's considered short term. If it's held for more than 36 months, which is 3 years, it's long term. So please make sure that you take a look at the actual rate at the time of paying tax to ensure that you're making the correct calculation. Now, in case of dividends, it is taxed at the applicable tax rates in the hand of the investor. These are some of the common mistakes to avoid while investing in mutual funds. The first one is not aligning a financial goals or risk appetite to the fund that we're investing in. The second one is actually looking at the past performance. Though it's important to take a look at the past performance before making any investment decisions, it is also important to review the consistency of the fund and ensure that it's aligning with our goals. Another common mistake is not doing enough research. The points to keep in mind while doing a research for the mutual fund is the amount of investment needed. Some mutual funds require really high initial investment, whereas some require low consistent investments. The one is to look into the expense ratio. Another thing to keep in mind is the lock-in period of the fund. So some funds like the investment linked savings scheme ELSs have 3-year lock-in period, while other funds do not have any lock-in period. The reason why lock-in period is important is also because some funds charge something like an exit load. If you're going to exit the fund early before the lock-in period expires, this exit load is going to be a percentage of our return. So again, our profits or return from the fund are going to be impacted if we do not have the lock-in period in mind. Another common mistake is timing the market. So mutual fund is typically a really long game, which means that sometimes even when the market goes up or down, keeping our money in it will ensure that we have an average rate of return. So instead of trying to predict the market highs and lows, one way to reduce this risk is to invest consistently over time through something like SIP. Another mistake to avoid is to not regularly check in with the performance of the mutual funds. It's always important to ensure that it is going in line to what we expected, or if not, or in case of any change in our financial goals or risk appetite, to rebalance our portfolio to ensure that it is going okay. Another thing to keep in mind would be not over investing in one particular mutual fund. So if you have different financial goals or different risk appetites, the smart thing would be to invest in different mutual funds, which would invest in different kinds of assets so that it's not concentrated in one single place. And that's it for this video. I hope this gives you some basic knowledge of mutual funds, and I hope it helps. So see you again in the next video where we talk about something very interesting and break it down into simple basic concepts. Till then, bye bye.